We'll do it live.
Okay. No.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
All right, welcome back to the Capital Mindset Show, everyone. Hope you guys are having a great day as always. We have a lot to go through, a lot of earnings to go through, and it's been a while since we went live. I think I went live after my vacation, if I remember correctly, but that's it's been a very busy time, as club members might know. But let's start right off the bat. And while we're talking about all these conversations, oh, by the way, Bob the dog, if you refresh the stream, you might see in the description below, because I put it afterwards, all the topics that we're going to be discussing here today. And so it's more or less in that category, but Meta is. So when I say earnings week, we're going to be going over all of the earnings, the major ones, and then we're going to progress over Google being back. That's kind of part of the conversation of Google's earnings. So those are more so intertwined. We're also going to be discussing about people trading Tesla, because I do have we'll get to that. We'll actually get to that. Okay, so Alphabet reported earnings. They were up quite nicely after hours and then throughout the next day. What we saw from Alphabet is I think a major change in the way they sort of think about capital return to shareholders. What do you think about the dividend?
Interesting. It's curious to see two of the bigger proper tech names. I wonder though, like, no. I'll hold off on the other one that is like, yeah, you got it. That smile, where I was hinting.
So I'm basically becoming a dividend growth investor just by virtue of my company starting to initiate dividends. We had Salesforce, Meta, now Alphabet report that they're now going to be paying a dividend. So my portfolio is actually becoming a cash flow dividend stock portfolio, which is, quite cool. I think it's cool. Just kind of watching all these businesses that, we've had investments in for quite some time, just become these things that a lot of investors who sort of praise and preach that you should be investing in dividend growth stocks. Well, look at this. And probably what's different now is the yield on cost is going to be quite nice, especially I think going down 5 years down the line on some of these investments. Now, recall that, well, Meta is not that old of a position. It was an anomalous period where basically it erased years of returns. And so that's why 2022 was just like such a phenomenal year to be an investor. So it was basically like going back in time and investing in Facebook way back in the day. So it was a great opportunity. Hindsight's 2020 though. So Alphabet, now this one's been long time hold, and for the first time in a long time, there's going to be cash being distributed from the investment. And so now, I mean, we can look at it from just a view that I see that Alphabet's becoming a more mature business. I'm not surprised entirely by the change, given what Meta did. And Alphabet's been one of the big tech firms that has been notorious for hoarding cash. They still have about 100 billion between cash, short-term securities, etc. So why are Google and Meta paying dividends? Why now? Oh, well, answering that question exactly right now. That, yeah, Alphabet, tons of cash on the books, more cash than what they really need to realistically invest in new projects. And so there's pretty much only one thing to do after that. How do I return capital to shareholders? Now you have two choices: dividends or share repurchases. Speaking of share repurchases, if you guys also didn't see from the earnings report, they also announced a $70 billion buyback, which is insane to think about. It's small for them, but that's, for some companies, that's their entire market cap and then some. So let's take a look. I'm going to pull up their actual report. And this is where we'll get started. So if you haven't seen this, or this is the first time you're seeing this, there's quite a bit to go through, at least for highlighting. purposes. So we did see that revenue accelerated yet again by about 15% year over year. And if you adjust for currency, it's up 16% year over year. Now, net income, when we get to the actual net income growth, I think it was like 50% year over year. And that's, again, achieved from a lot of operational efficiencies. They also started to really focus on firing employees that were probably redundant. And when we look at the growth in various business lines, we start to see really good acceleration in YouTube. You're watching this most likely on YouTube. And we also saw really good increase from Google Ads. While Meta's was a lot stronger, Google's is still pretty strong and still very impressive business. This also bodes well for another business that's reporting earnings this week, Amazon. Let's see. Cloud growth was also really strong, but it's still the number 3 player when it comes to cloud of the big 3. So for their hyperscale offerings, nothing to really brag about, but growing quite nicely, and eventually will become something that's a lot more material than it is today, hopefully for Alphabet. Now, Google subscriptions, this also grew quite nicely. You can think of this as being the YouTube Premium that you might also be subscribed to. This could be, I think it's called Google, not Google One, that's Apple One. Google, I think it might actually be Google One, but it's the premium Google subscription service where you get access to Gemini Pro. Speaking of Gemini Pro, well, actually, we'll get to that with Meta, but Gemini Pro is good for what it is. If you guys use it, the integrations that's coming for Gemini Pro into Google Sheets, Google Docs, it's already there, is going to be really good, especially for someone like myself who utilizes these products. I can then draw insights from my own data and then kind of see or visualize it in a maybe an easier way than normally. What I would normally do is do it manually. So allowing it to automate some of these tasks is really interesting. And overall, strong growth in the top line, really strong growth in the bottom line, and really massive shift in how they're deciding to sort of view shareholders and treat them as far as capital allocation goes, with a buyback, really strong buyback. They've been doing buybacks, but the dividend. And so it's kind of signaling to the investor base, it's sort of a not a new era, but it is a new era. So yeah, to finalize the answer to that question, it's basically signaling that Alphabet's a more mature business. There's more than enough cash to go around to fund the business and reward shareholders. So those of you who've been invested for a long time are now reaping the rewards of that investment from all those years ago. And realistically, the capital return policy is, is this happening? Where Alphabet and Apple hoard cash, it's fine, but when Bob and JD do it, no. So I don't know if you saw when I clapped back at you, Elemental, in the last live stream, but I broke down specifically why the JD and Baba discussion is nuanced and why when they're doing it, it's actually bad. So if Alphabet's hoarding cash, but the valuation of the company is nothing like maybe, I don't know, all-time low, then and they are doing a buyback policy, you would want them actually to be reserved their buybacks and maybe more so focus on dividends. Now we haven't praised Alphabet's policy of hoarding 100 billion plus in cash in the past, although it's something to think about for let's call it the safety of the business, being a fortress balance sheet. That's fine. And relative to the size, it's fine. So if you're trying to do an apples to apples comparison, this is where we'll clap back again. So if you look at the Chinese VIEs, they have a cash hoard that's utterly insane for the size of the business, and the shares are trading at an all-time low. And if you're trying to at least showcase that you're going to reward shareholders to some capacity, then now is the time. You don't want to take the chance that later down the road, that's kind of ridiculous. But now is the time where you want to be very aggressive with your share buybacks, because presumably on a cash yield perspective, it's going to be quite difficult to make that justification where you'd rather hold it and earn, I don't know, 5% or whatever, versus investing it back in your own business or your own shares and getting I don't know what Baba's is trading at for a cash yield, but I presume it's well over the risk rate, like significantly over the risk rate. So in theory, we would want to be seeing that, but you're just not. And Alphabet's completely different situation. Also, the comment on Apple in that, I know that you're probably joking, but you have to be joking for that. But because Apple's cash hoard, they are absolutely insane buyers of their own stock. They actually don't have a cash hoard relative to their size. It's fairly normal. If you view it as a percentage and you kind of adjust for the scale, you see that it's nothing out of the ordinary. What is out of the ordinary is JD's cash hoard and Baba's cash hoard. If you told me that the goal or the point was to coddle the Western investor, make them feel good, make them feel safe, you would do a token buyback, something that isn't really meaningful, doesn't actually harm your cash hoard, and you're rewarding non-shareholders with some capital in lieu of trying to make sure that you have access to cheap capital. A company that actually is trying to or views its shareholders as actual shareholders doesn't really in my opinion, shouldn't really do moves like that. They should do moves that reward the shareholder. Then we get back to the question of what's the point. I know we went back and forth and said that they shouldn't be rewarded, or the shareholders are second to whatever. And then it's like, okay, we can get back to the point of like, then why invest in it? We get into the circular argument. At the end of the day, why would we even invest in it? Okay. Yeah. So let's see. If you had to pick between Meta, Google, and Amazon, which pick would be at this point going forward? No, it's easy because I just will say what I've been buying more of. Amazon.
Yeah. Well, I mean, but to be fair though, like you're already significantly positioned into Meta, so it's not like you're saying, "Oh, Meta is absolute dog crap."
No, yeah,
And
I'm not.
yeah, and you still hold Google, so like if Google was really that awful, you would have like axed it.
Precisely.
Yeah.
Yeah. Now with Alphabet's earnings, that's pretty much summarizes the gist of at least of what's important. But in terms of like what I'm going to be doing with the investment, absolutely nothing. The dividend that's going to be coming in, I'm going to just more than likely reinvest it selectively. Now the valuation has come up a little bit, but relative to other big tech firms, the valuation is not egregious. And I don't think oh, you already okay. I guess we can talk about it. Amazon
Oh, yeah,
by
yeah,
Bloomberg.
yeah,
Yeah.
because we got the X date that showed up on what appeared to be a Bloomberg terminal. Not that
Yeah.
I would know because I don't have a Bloomberg terminal, but I could be sponsored.
So how do I feel about this? I guess we can talk about that. Let me
Around the
actually
corner.
respond to this.
Yeah, because Amazon reports after hours on Tuesday this week.
Hold on,
So that'll be interesting. While Fabio is doing something, be sure to like, comment, and subscribe. Helping promote the channel while Fabio is busy at work.
I'm just saying I'll respond to this in a sec.
Oh snap! Look what the cat dragged in. You're supposed to be on a boat, good sir.
All right. There we go. We shouldn't be bothered for the remainder.
Yep.
Bobby has a Bloomberg terminal in every room. These are lies. And what up, Andrew? How you doing?
Yeah, he's supposed to be on a boat.
Sitting on my plane waiting for takeoff. Oh, yeah, he's going to be back. Meta narrative repeating itself. Actually, I was going to save that for the Meta earnings. We'll go right into it. Meta earnings. It is absolutely repeating itself. It is so egregious and terrible. Okay, so my conclusion is that when you're watching people talk about Meta earnings via Twitter, YouTube, if they repeat the words metaverse spending being a problem, they're illiterate. That's the only thing I can conclude now. They're illiterate. And I've seen it again and again and again, and even now. So the capex, let's kind of turn back the clock a little bit. The year is 2022. You have clowns come on YouTube talk about metaverse spending. And again, the reason why I'm being so colorful with the language is because they had access to publicly available information, the same ones that we have access to. The language is the exact same, and it could not have been more clear. It literally could not have been more clear where the spending was going. They even gave you colorful charts showing you where the capex was going, where the spend was going, colorful charts. Okay. So when you take that into consideration, and then you then conclude from that there's going to be all this spend in metaverse, then I can only conclude that you do not, either you have malicious intent for whatever reason, I don't want to ascribe the reason, or you just cannot read. Or the third option, which is also probably true, you are lazy. That's probably the most likely. You are lazy and you decided not to open it up, and you just parroted information you heard on the internet, which was to everyone's benefit who bought the stock, because that was a very weird time. I cannot express to you how weird that was. That normally people are quite rational. They pull up the same financial statements and everyone can see. They pull up the same presentation and they read the words in English and they look at the charts and they come to more or less the same conclusion. And then there's really debates about the future, but not about the current, not about what is currently happening. Debates about the future is perfectly well, because we're all have our own opinions about what the company's going to do. I don't know, in the next 12 months, in the next couple years or so. So yeah, that was very weird. If you look at it today, people are repeating that. And I saw a post on Twitter. I won't say who, because I don't want to be mean to this person, but I imagine many of you saw similar posts on Twitter, or you might be knowing the one I'm referring to, that Meta is spending money into a project with an unknown payout. I don't know what to tell you now, because has the last couple years or so not been evidence enough that the capex was done mostly for an infrastructure that benefited family of apps and boosted margins by quite a bit, boosted sales by quite a bit, improved the efficiency of the advertisements. Now you could argue that, okay, no, they improved in spite of everything and management's lying as to the cause, but they did improve. You cannot deny that all these things did happen. You can then say that management lied about the cause and it's just that the business itself is better, or people are just spending more on Meta for whatever reason. But that's kind of getting into the realm of like, I don't know, you're kind of reaching for the conclusion without corresponding evidence. So Fabio's one step from blaming the hedgies for sure. No. So actually, I'll talk about what I did. So before we get to the portfolio update, it's not actually it's not going to show in the personal holdings, because I haven't done in the personal holdings, but in the holding company, the brokerage that I show for club members, by the way, the link is in the description below. That one, people saw that I haven't sent out the update, but I'll send out the update today. But when you see the update, you'll see that Meta has increased. You'll see that the share count of Meta has increased, and that for the first time in a long time, we took advantage of the sell-off, in this case for Meta, because I frankly saw nothing wrong with the earnings. And again, the narrative started to pop up that, oh, capex is increasing by 3 billion. This is terrible. I view it that if you're if you're a hyperscaler and you're scaling back your capex, right now that's a sign of weakness. So all of them, thankfully, so far have insinuated that they're going to further increase their investments. And frankly, by not much. Like Meta's was 3 billion increase in guide, which is a drop in the bucket. So I didn't view it as a problem, but the market for some reason did. And then forward guidance on growth, yeah, sure, it was tame, but I actually think that's them being a little bit conservative, honest but conservative, and I think that there's likely they're going to surpass that. Even if they match it, it's frankly it's fine, because what I see that the company's capable of doing going forward afterwards, and with some of the capabilities that they're developing, it's starting to get more interesting as far as the business applications and some of the moves they did, such as partnering with OEMs, and then providing the OS for the virtual reality headsets is finally a way that we can see them monetize Reality Labs. But the problem with the kind of identifying monetization of a business line, let's take Reality Labs for example. You don't really see the monetization besides direct sales of devices. So when they sell the glasses, that's a way you can see it. But you need to understand that because you're looking at the whole, you have to look at holistically what's happening with the business, because investments done at Reality Labs sometimes doesn't attribute or isn't accounted for in the net benefit to another business. Such as, for example, you look at investments in artificial intelligence. You don't really see a line item telling you, revenue from artificial intelligence, but you see that family of apps has improved dramatically. So then you, as an investor, have to sort of put the puzzle pieces together. Otherwise, you're just going to miss out on the story. You won't understand what you're looking at. You'll hear narratives like they're spending a ton of money on this or that, and there's no direct benefit. And so because you're not able to put the puzzle pieces together, and then then it's not for you, and that's fine. That's actually a completely rational thing to say. It's not for me. I don't understand it, and you move on. And then that would apply to pretty much all the other businesses that we talk about. Like Alphabet's cloud business has value beyond the actual cloud revenue that Alphabet generates. It has benefits to YouTube, has benefits to Google search, has benefits to the enterprise at large. And so it's very difficult to pinpoint and attribute the exact value proposition that Google Cloud is basically providing. So let's see. Sentiment follows price. Meta at $90 equals doom. Meta at $440. It's the future, bro. The fool. Yeah, but you think that, and at the same time, the report comes out and certain details piss investors off, and I view them as like, again, you should be shaken out of the stock. You shouldn't own Meta. It should be, I guess, I disagree with the conclusion that the capex is bad. I view the capex as necessary and part of their competitive nature and the moat around these businesses. So, hey, welcome, Rob. Can't go wrong with Meta's moat. Oh, absolutely. Like people like Kevin buying Meta now, if it comes down on next earnings from more capex narrative, then many panic sell and push Meta down to the team's multiple again. I don't view Kevin as a legitimate shareholder. Don't worry. He trades in and out of things like nobody's business. He has no core holdings. That's what I like to say. And I probably will, if I remember to do so. I'll talk about the weekly call this week. So earlier this week for the club, we have what's known as the weekly call. It's once a week where it's basically just me and all the members, and it's a recorded session. And I talked about the trades that Meet Kevin has been doing. And also we looked at this guy on Twitter who trades in and out of stocks. Or not trades in and out of stocks. Sorry, wrong guy. Who's a Tesla bull, and he traded out of his stock. And also he was caught lying, but anyways, he's a clown anyways, because what he did is he sold Tesla before earnings and shorted it. And so he is the classic retail investor, because going up to that earnings report, he and I tweeted this, actually, it's best to bring out Twitter and show you guys the pictures, because I took screenshots, or I grabbed the screenshots from club members who sent it to me, and basically wanted to record it on the internet forever, so that just in case he couldn't delete it. And I even dated the post. Okay, so share this post, or share this tab instead, and it's referring to this tweet from the guy. There's his name, Squawk Square. So I love when rookies and non-professional trade. By the way, this guy's a clown, because he started investing, I think probably like 2020, based off how he talks, his demeanor and all that. But I love when rookies and non-professional traders try to come at me like I'm an idiot. You are. Sorry for the tough language, but he's also a liar. So I also,
there goes the moving bus. Just
there goes
thrown
the
under
bus.
it.
Just wait another 2 hours and into tomorrow. We'll see what happens. Don't count your chickens yet. Yeah, clown. It totally went against you. So this is what he did. Sold another 2,500 Tesla at 146. A small loss. Will be because he's been invested in Tesla for a long time. It's been dead money. So he's already a clown investor because, I mean, he's underperformed the market for quite some time, and he's arrogant about it. Because I've at tweeted him a little bit here and there. Because it's always annoying just to him to come up on my feed and complain about nonsense. And he's blaming the Tesla underperformance on everything but valuation. Everything but valuation. So it's whatever. And then so he does that. And then he says short 2000 at 156.36. Most of the pop is in. Let's see now if I can make a few dollars. Tesla, blah, blah, blah. And this is after he says this. Like I said, this is why I don't short Tesla. So he's an utter clown. He's an utter annoying clown. But I like to even though I'm grateful to have him on my feed because it's kind of like just random entertainment from just watching a clown show. So he does all this and he finally sells at one point and he buys Tesla. But the point is, the point that's really interesting, and this is why I'm really debating, I'm probably going to do it, grab the weekly call and clip the part. I'm not going to share the rest of the weekly call because that's just for members, but the part where I actually describe predicting what he would do. And it looks like he's going to do exactly what we predicted, which I said he's probably, this is going to go against him is the prediction. It's going to go against him and he's going to do the classic cover his shorts and then go long again. And then in the future, what's going to happen is it's going to go down again and he's going to have the same conundrum. And it's very possible to lose 90% on an investment without the actual investment going down 90%. All you have to do is do what this guy is doing. Do what me Kevin's doing. Just keep doing what they're doing. And it's very possible for you to go down 90% on an investment that has not gone 90%. Again, that's a skill. It's a skill on idiocy. It's a skill pertaining to revenge trading as far as like an attribute. So when you revenge trade like this guy's doing, very classic rookie mistake. So he's like, I love when rookies, he's a rookie because he's doing exactly that. He's revenge trading. You can lose more percentage than the actual stock going down. And he's done that. Now, as far as his fibs go, people have caught him in the past, sort of manipulating brokerage statements. And club members have shared that with me. I wasn't aware of that until someone shared that with me. So it's really interesting to just point that out that he has been called out, I think in like the year 2022 for doing that. But even if he isn't, and you're just going off of his paper trading or his ideas, if you follow his trades, they're really bad. And he's claimed to have made millions on Tesla. So usually if someone's made millions on something, they're not going to publicize it to the world. You just show percentages and that's fine. But once you start to like brag about millions, I don't know. Part of me just always thinks something's up. So yeah, me Kevin down 90%. I'm a long-term investor. Me Kevin up 10% after earnings. I told you so. Sign up for my course. Yes, because he makes money from his course more than anything, not his actual investments. That's rule of thumb, additional to everything else. But me Kevin also has been doing pretty much the same thing, kind of trading in and out of his core positions. So he doesn't have core positions. Club members know that I am guilty within the holding company, especially from sort of trimming smaller positions. But that's the key word. I go in and out of small positions all the time. It's frankly ridiculous how often it happens. And so, you can have, I'm not going to say dollar figures, but you can have in total dollar figures, a significant amount if you add it all up together, moving around. But if you look at it from the strategic overview, it's really in terms of percentage of the portfolio, it's a certain percentage that's constantly churning because we're trying to find a new idea. If it doesn't work out, we cut it. And if capital finds its home in the top holdings, the core holdings, then it really doesn't move because that's what a core holding is supposed to be. Then that's what distinguishes core versus ancillary. So there's supporting positions and then core positions. He doesn't have core positions. He just has only trades. That's all everything is. It's gambling. And I know that because people have shared it with me that he's going, he's also already made it public, that he was buying call options on Tesla, pretty short dated call options expiring in early May. So he's frankly gambling on the upswing, but
Very nice.
yes, Henry, you're remembering correctly. Well, not entirely true, because he sold his entire portfolio and opened the PP ETF. And so that's kind of his portfolio now. So you got to, I guess, consider that. But when you're looking at Meet Kevin, he's also a investor that had $40 million, lost it pretty much. He lost $30 million. I know that, roughly around that, because he lost about half of it, sold everything, and went cash in 2022, then went all in Tesla in the middle of 2022 when he visited the factory, and then sold everything again towards the end of the year, nearly the bottom, and then created the PP ETF and also House Hack. And at that time, he lost an additional 50%, because that's how much Tesla went down, addition to where he went all in Tesla. So that equates to roughly a $30 million, maybe a little bit less than that, loss. And then from there, he sold his real estate. He did a bunch of things to kind of get cash, bought the plane, all that jazz. So I'm getting added. Who's adding me? Is this Andrew?
It's Andrew.
It's Andrew.
Yeah, he really liked Rob H's reference to a Jeremy Lafifi moment.
Oh, yeah, that clown. So another clown. We're on
So many clowns.
So many clowns. There's so many clowns.
Yeah. The internet's just one big circus.
It's one big circus, exactly. Kind of interested in Google now. My beef with them was always going nowhere projects. Yeah. So honestly, with Google, I view them as they're such a good business with terrible management. And if management improves, you have a golden business, like golden opportunity, gold standard business. They have wonderful assets. It's just about utilizing them properly, not mistreating them. YouTube's wonderful. Search is wonderful. Cash cow. You have cloud in there. Frankly, they should have been the number one in LLMs, but they dropped the ball. And let's talk about Meta. Meta also released the new LLM for them, and it's honestly better than Google's, and it's free.
Llama 3, you're referencing?
Llama 3 is better than Gemini Pro, hands down. It's significantly better, and you have to pay for Gemini Pro. It's cheap, but you have to pay for it. While Llama 3 is free to use, and it's better. It is better. I own both, but Meta's is better, hands down. It's much more capable. It never had the same glaring issues when I was using it. Gemini Pro is improving, but Meta's, I think, is right now, as we speak, the best one. I think it's even better than Copilots, and it's free. Now, the difference is, like, Copilot and Alphabets, they can be integrated into these other tools that you use, which then make them in the work case and a work environment a little bit more useful. But I can only imagine if Llama 3 was implemented in these tools, how much better it might be. But that being said, we talked a little bit about the agreements with OEMs to produce new products and the partnership with Microsoft, the continued partnership with Microsoft for the metaverse. This I view as Microsoft sort of hedging their bets and making sure that if the metaverse is something that does sort of grow tremendously and become more popular, that they're positioned in a way that businesses are still going to be using Microsoft products. And also, it's kind of like a kick to Apple. So go figure that the Apple Vision Pro was sort of a failure. We already knew that it was going to be. It's a pilot program, if anything, and it has to be a lot cheaper in the future for it to ever get to mass consumer adoption. Something that the Meta Quest Pro is definitely much more affordable and just as capable in the things that matter. Obviously, Apple's product has a lot better quality for some of the components, because you're also paying like 10 times more money for the same product. But for the price point, the difference, the Meta product is far superior. Going forward, the next glasses I'm going to get are going to be the Quest glasses, just because it adds additional functionality for not much more money for regular glasses, and you can get prescriptions on them. So I would rather just have more functionality than less. And in addition, I find some of the features quite interesting, novel, but quite interesting. Like I can ask it certain questions about the world, and it views the world through that lens. I don't view it as something to take pictures with, but as their AI gets better, I see better ways to harness data and then make some of the other businesses better. And that's why, again, someone who doesn't understand the business is going to look at that and see money pit versus something that you have to sort of be creative with the accounting as far as attributing the net business benefit. Most people won't do it.
It is crazy because, like, as a little niche thing that I've been curious with was like plant identification. And you would think like Google or Alphabet's like one of the core statements around it was way back when was like quote don't do evil. So not necessarily like be good and be great, but you would think like way back when Google had Google Glass, uh it was one of those things where you could have like at least partnered up with like national parks or like nature reserves and whatnot, and been like, all right, if we can just make these products more affordable, we can already master the data side, the back end side, and partner with people that care about nature conservation and monitor invasive species, what have you. Just like very very niche, but like hey, doing something cool, add a little bit of ESG points, what have you. But no, no, no. It seems like Meta is the one that's really pushing that the B2B possibilities. Because when people hear metaverse, they probably think cheesy graphics, wacky Roblox type, scenario. Whereas I'm thinking if there's B2B applications for like manufacturers to be like, hey, workforce, you have these headset or whatever setup that it is assists you in the product as well as being an element of quality control or assurance. uh, hard to see why not if the price is affordable for a manufacturer to operate with that.
Yeah.
uh, oh, maybe I'm thinking wrong, maybe I'm the delusional weirdo here, but
No,
I
yeah.
could see a real value prop here, which could be a revenue source for Meta.
Yeah. I see a lot of levers that Meta can pull. And
Yeah.
I'm trying to not be biased because I'm a Meta shareholder, but
Mhm.
there are a lot of levers to pull that I did not ever account for when I originally invested in Meta because I valued certain projects as zeros.
Yeah.
But the core business itself is very, very, very good. And if anything, you have to give credit to management because they told you that these investments were going to do X. And you can get into your conspiracy theory that it's not working or it was a waste of money, and say that, okay, their core business just got a lot better, but it's not because of what they did. And it's still a money pit. But then again, where's your evidence? You won't have the evidence. So at some point, you kind of have to come to terms with the fact that management said these investments are going to have X effect on our core business. You saw X effect on the business, and you have to then trust management that it is what they said they were going to do that then would affect the core business or not. But yeah, I don't view it as a money pit. And there's also additional inventions or innovations that came out of Reality Labs that really have a lot of medical application that you actually might see some medical businesses being created or spawned in as a spawner of that Meta is inside of the company. I'm really curious to see if that ever comes to fruition, but you don't need that to happen is the cool part.
Yeah.
Like that doesn't need to happen for the thesis to work out. And hence I viewed that the business is doing precisely what I expected it to do. Management is doing precisely what I would want them to do. So when the share price went down on those earnings, there's only one conclusion I could possibly have. And plus, when I redid my evaluation off of new numbers, new estimates, I viewed that the ideal price, and I'll share this with everyone, but my ideal price to add is actually in the around $370. That would be the ideal price. But I'd never wait for the ideal price. Sometimes I get it, but that would be like doing like a Paul level DCF and just saying like, half the price of today. Because that's the level of his analysis. Half the price of whatever it is today, and I buy it there. You'll never buy anything good. You'll only buy crap. So sometimes we get the precise point that we want, and that will affect, of course, your allocation. So you have to have a portfolio. Picking an investment is part of the battle. The second part of the battle is portfolio management.
Yeah. Oh, for sure.
Yeah, that's why we have, analysts and PMs. Analysts, PMs, analysts.
Yeah, and if you
It's
want to
half
do
the
this
battle.
yourself, you got to do both, and you got to not screw up at both.
You got to do both, exactly. And it's its own difficulty.
Oh yeah.
Okay, if I may respectfully critique your portfolio, it seems that you spread yourself too thin. How can you keep track of all your holdings? I would have to respectfully disagree with spreading myself too thin. If you look at the top allocations, it's very concentrated portfolio.
Centered around only like 2 ideas, more or less.
Yes. Oh, and you're talking about the holding co. Yes, even more. So the holding co probably has now four, because I have to release the update to club members, but 4 big ideas that are all roughly the same size. The personal holdings is also, I would argue, similar. 4 core holdings that make up the vast majority, and some of them are growing. But if you want to expand that, I'd say the top 10, and I think the top 10 are 70% of the portfolio, 70 or more % of the portfolio, and the remainder don't make up too much. So I believe that, my pushback to that comment is it's quite concentrated. There might be an illusion because the sheer quantity of stocks is like over 20. But if you look at it from just concentration and where my mind is probably going to be more focused on, and there's positions in there that their earnings could come out, and I probably wouldn't look at them. They'd be such a low priority. But really, like, for example, the big ones that came out that I was looking at their earnings was Netflix, Meta, Alphabet for this week, because they were one of the most material. But there's companies in there like Allison Transmissions that I looked at their earnings, but it was on the lower part of the priority list. If an idea is less than 2%, is it enough to move the needle? Is there an opportunity cost to allocating such a small position when you add to an existing good ideas? It's not so much that the percent allocation is meaningful to the holistic view of the portfolio, because it's not, because some ideas have ran up so much that it's not, well, actually, that's not true anymore. But prior to 2 weeks ago, it was not possible for me to allocate more capital to something that would make it that big without selling the top ideas because of the movement they've had. So there was nothing that I could do within my power to get a position to the size of Meta or anywhere near Meta without selling Meta and then adding that capital into that idea. So I view it from the perspective of net new capital allocation. And I don't share the dollar figures, but I also view things on a form of materiality for my own expenses in my life. Yes, the percent stuff is important, and it's a judge on total strategy. But there are ideas that I allocate to that you could argue don't have a significant percent move, right? Upside, as far as like how it will affect the overall performance of the portfolio and therefore judgment on the performance. But if the idea works out, and I do believe in the idea, can have a material impact, nominally speaking, on my life. So, as an example, just to throw dollar figures out, for most people, earning 10,000 plus on an idea would be material, nominally speaking. But if someone hypothetically were to have, I don't know, portfolio than that, maybe it doesn't move the needle percentage wise. So let's see. Do you think smaller portfolios should be more concentrated? Oh, this is a great question. I'll let Bacon start.
Oh, is it because I'm a quote unquote poor? Okay, all right. Smaller portfolios. I am hesitant to necessarily be construed as financial advice in general. That being said, if it depends on the person and what their end objective is. If you are wanting to learn and are majority indexed majority safe, relatively safe, and comfortable with what you're doing, then I can see arguments for being, a concentrated smaller portfolio. If your end goal is to say, "Oh, I want to see if I'm any good at this and want to try and maybe give it a hand," where your I don't know, individual like Roth or what have you will eventually be like that, then there are strong arguments for practice how you want to be. Like, what do you envision? Uh, it's a great. It, if it's relatively small, I could see the argument for, hey, like, I just want to see if this strategy, if this thing would work with out of sample data, so to speak. That being said, there is a fallacy component, which Fabio, you've mentioned numerous times, where, oh, I lost money back then. That doesn't necessarily count. It'll all earn back, what it is, and then some. Maybe not so much. So it it depends, I'd say. It really depends on, I guess, what system, what approach you're going with, and your own comfort level. Like,
Mhm.
some people will lose sleep if Meta were, as a random example, if Meta were to run up so much in such a short amount of time, and it go from like a low single digit percentage to a double digit percentage. Some people are panicking if it's done pretty well and all of a sudden drops 10%. Like, there is a mental, emotional, psychological aspect to this, whatever approach you do. So, me rambling here is just a way to say whatever it is, probably going to be wrong, but just be comfortable with what you're doing and be okay with whatever outcome
Yes.
ultimately.
No, I tend to agree there. I tend to agree there. It's I don't I would highlight that, yeah, I don't think that necessarily you should change it all too much just based off concentration, based off size. But I think it also depends, right, on how much income you have,
Hmm.
right? Because if you have, let's say you have a $5,000 portfolio and you're saving 1,000 a month to invest, you could probably make the argument that what is your best idea right now?
Yeah.
And then don't worry, at the end of the month, you'll have 1,000. The next month, you'll have 1,000. And so you could find a new idea. But what is your best idea right now? And you can make that argument because you're building it up. But when your income maybe or your contribution rate starts to become like single digit percentages, that's when you start to have that conundrum of, okay, maybe now I can't afford to really I guess express all these different ideas, or sorry, all into one idea. It wouldn't be responsible because then if I needed capital to shuffle around, I really don't have any options if things go sideways on this investment. So I think it's really depending on the individual person. But
Yeah. Yeah. Because, like, you could go out this any number of ways. There are so many ways. You know, if you're an individual picker, there's more of a GARP, growth at a reasonable price method,
Mhm.
or more of a value bias or skew, or whatever value means to you. Like, I, and there are people that would do a little bit of both, a combination of both. So, up to you, and how you do it, and just be careful and be aware of you know any and all outcomes, and be prepared.
Yep, and I agree with this too.
Yeah.
Yeah, it if it depends on your goal. If your goal is more capital preservation than just growing that net worth, like you would argue, or you could look at my portfolio again, Henry, and you would say I'm very concentrated.
Hmm.
I'm very concentrated, and I made a very concentrated bet in 2022 into pretty much a few names, and then even with the newer names that I bought in 2023, pretty high concentration into those. So then there's a bunch of supporting positions. The holding co follows the same principles. It's relatively concentrated. The top four positions, well, I should caveat this, and Bacon knows exactly what I'm talking about. Club members probably know exactly what I'm talking about. With regards to going forward, the percentages are going to get very wonky. No, percent allocations are going to get very wonky. How should I phrase it without, like we discussed before?
It's a thing that has a lot of academic study behind it. So
Yes.
while conceptually I get that a lot of people may panic or be very, very averse to it, when the thing is done properly and responsibly, and when the added monies that like make the percentages look a little wonky are done properly and responsibly, it's really a non-issue.
Yeah.
In my view, like it's funny because like even like a little bit of a peek for the public behind the scenes, like there are respected members of the community as far as being very aware of things from a finance perspective or an accounting perspective or what have you. And when they heard what you were doing, their immediate knee-jerk reaction function was, "Oh, this is horrible. This is awful." And you take a relative generalist, just person who wants to learn like me, and I'm like, "Oh yeah, that's kind of boring, and I already know where you're going with this. Like, I don't have a problem with it, so long as like you're careful and responsible with your own allocation." And so on. Like, so yeah, like it is to me, it's a non-issue. Uh, like
Yeah.
not to like I'm trying to respect like your reason to not be as open about it, but
The privacy
yeah,
of it. Well,
privacy.
not the
Yeah,
privacy of it, because not private, because the club members know exactly what it is, but
mhm,
just abundance of caution, because it could be done in a very irresponsible way, and
yeah,
some people might be better off not even knowing this is a thing.
yeah, yeah. Because it when it's done improperly, it is a really dangerous thing. Like,
Yes.
yeah, horrible things can happen.
But effectively, long story short, like I was kind of alluding to, prior to 2 weeks ago, it would have been impossible for me to grow a position larger than Meta. That's no longer the case.
Mhm.
So, what's that? What the fuck? I'm Bacon's biggest fan.
Yeah.
Yeah. All right. Let's see. Question. Amazon is now 840% of my entire portfolio after recent run this year. I'm struggling now. Should I sell some since I'm 100% invested, or just keep it as a piggy bank? Well, there's a saying, there's a million reasons to sell something,
Yep.
and not everyone has their own reasons. I don't view, if I had 47% in Amazon, given all the facts I know now, there's not a reason for me to sell it right now.
Yeah. Yeah,
There
because
would be no reason.
there
I'm
are tax consequences. What other ideas you have? Blah blah blah
I'm
blah.
I'm covered. I'm covered from my income. All
Mhm.
my expenses are covered. I don't need the money. I don't like pay tax if I can avoid it. I actually don't think that the stock is terribly overvalued at all. I think there's a lot of things that Amazon can do to pull some levers and generate more income. There's not a reason for
Mhm.
me. If I needed the money, that's a reason. If I yeah, basically only if I needed the money. That would be the only reason why I would sell it. If I
Yeah.
needed the money, but I don't need the money.
Yeah.
And
And
so it could do whatever it wants when earnings comes around. If it goes down, you could argue, "Oh, you should have sold right before and then bought back." No, I don't play that game. And especially considering you do have to factor in taxes. For example, if I had done that to Meta, uh, I would not have come out on top. I would not have come out on top. I would have actually lost money doing that. In theory, selling it right before earnings and then buying it right back. Of course, in the near term, in the now, yeah, I would have probably made more money. But for the time being, because of how quickly it kind of snapped back, arguing maybe I had perfect execution, maybe actually I did make money, but that would be perfect execution, like selling right there and then buying at the exact bottom where we could possibly have done it on the market open. Impossible. Okay, so I think with that, we can go over into the Microsoft earnings. Wow, Microsoft earnings. MSFT.
Microsoft. Yep.
Wonderful earnings, honestly. Wonderful earnings as typical, and it went up an additional 4%.
It's such a monster.
It's such a monster. Yeah. So Microsoft, great earnings, continues to be number one business. Trades expensive, not for me. I wouldn't want to buy it. But I think that it's admirable to look at them, see what they've achieved. My one complaint that I've complained to the club members about with Microsoft, which I really don't like, is that they don't break out cloud into Azure and everything else. It's really ambiguous. You kind of almost have to just guess what's Azure and what's everything else. So I hate that, because at least with Google Cloud, I know Google Cloud. AWS, I know it's AWS. Microsoft, I have no idea. I know cloud is growing at something, but I don't know what is growing. So I don't know if it's Azure that's growing, or it's other things that are growing, or Azure's growing and the other stuff is going down, or Azure's not growing that much and other stuff is growing more. I would guess that Azure is the one that's growing a lot. I would guess. But then it also could be other stuff is growing more than Azure, but Azure is growing. And so it makes Azure look better. And then everyone then concludes on the internet that Azure is growing way more than AWS, when it could just be Azure is growing somewhat like AWS, sort of in line, and it's decelerating. And then other businesses inside of Microsoft Cloud are growing a lot. It's unknown. It's unknown. Not enough carrier talk. Ew.
Well, you don't like Carrier? It's another good company.
No, I do like Carrier. I'm kind of butthurt always about Carrier, because when UTX did the spinoff,
Yep.
I bought Otis.
Oh.
And not Carrier.
Oh.
I did well with Otis.
I was gonna say, yeah, like, didn't they both do well? Like,
they both did well.
Yeah.
But I would have done way better. And I looked at the two, and actually, funny enough, at the time, the multiple on Carrier was low teens. It was low teens. It was cheaper on paper, but I view that, okay, Otis Elevators is a better business. The service business was really attractive, but it didn't do nearly as well. Carrier was much better investment. And then Carrier now is trading, it had multiple expansion. But by the way, that's like a lot of the return for Carrier. So Carrier did grow, but a lot of the growth on the share price was just the market saying we'll pay more for the same set of earnings. Now you could make the argument, which is very true, that now Carrier is arguably exposed to really attractive businesses. That being, they're in the data center business, which, if we talk about a lot of the investments I've been making, is a lot of DC related businesses. Yeah. There's been, actually, when we get to the portfolio updates, there's been some sales for sure that we're going to cover. We can talk about Intel, because Intel, I can pat myself in the back. Do you think that's okay?
You can pat Gelsinger yourself on the back.
I can pat Gelsinger myself on the back, because Intel, Bacon's also participated in a lot of these accidental trades. I have such a long history. It's all on YouTube. We buy Intel, and then we find a reason to sell it, and then it turns out that reason was great, and we make money, and it proceeds to go down. And we've had the opposite luck of Paul Gabriel. And I think that was like the 5th time while I've been making content on YouTube that I got involved with Intel. And then somehow we sold it for arguably the right reasons, and it turned out to be the right reasons. So let's kind of talk about that now.
I think I only did it like 2 or 3 times. Like, you definitely have done more with Intel, and yeah.
But like, I want everyone to know, it's like, I didn't know that it was actually that bad. But when you listen to the logic, it makes sense. And what I expressed to club members when I sold Intel, or how I explained the rationale for selling Intel, was when it moved up to, and I didn't sell here, by the way, I actually sold here. This was them revealing the fab business. And I want to time it. This would have been the best time to sell. This was the best price, and it's now down 37% since then. But we had a cost basis in the 20s for Intel in the most recent investment. And it was a pair trade of TSM and Intel. So I had both. If you guys recall from prior portfolio updates, I had both TSM and Intel. And what I've thought of is, okay, I know that TSM number one fab business. Intel is going to be number 2. I don't think it was priced in for that. For whatever reason, the market's like, at some point woke up and was like, oh, Intel fabs, run up the stock. And so the stock just kept climbing. And I was like, nothing's happening. Why are you climbing? And then, people would be like, but Fabio, the markets are forward looking. I'm like, yes, but we have no idea. It's not like we have a business and we can kind of project out in the future. We have no business right now. Well, virtually no business, relatively speaking, to what the goal is. And we're making really lofty assumptions. And eventually, there was the announcement. I think at some point over here, I think this was the sell-off, where the announcement that they were, delaying it. It was not going to happen. And then that was already where I started expressing in the weekly calls that, already saying the idea, Intel is not priced appropriately right now. It's really pushed out into the future. And then this one was kind of me saying, oh yeah, enough is enough. So we sold Intel and we threw it into TSM. Great move. Hindsight's 2020, but great move. Looking now at the investment, it's come down quite a bit, where it's now within that realm that I had originally penciled out as sort of the valuation where it's fair / appropriate to think about making an investment in Intel, under the premise that eventually their fab business will be number 2. I ignore Pat and some of the club members who are more technologically inclined than myself on this topic have been calling Pat Gelsinger outright liar.
Oof.
And I don't like to hear that from them, because, I learn a lot of things from them as far as what Intel is doing. And for them to use that strong language, of course, it like makes me go, okay, he's lying. Like their professional opinion is that he is lying. And basically exaggerating truths is maybe a more accurate way of saying it. Exaggerating greatly a set of truths. So I view the Intel question as they are saying that they are going to be number 1. I'm going to call that bluff and say they're not going to be number 1. But at a certain valuation, you don't need them to be number 1. You just need them to be number 2. And that's fine. I think that if you're paying $50 a share, or 47 or somewhere around there now, today, you are insinuating they're going to be number 1. And I disagree with you if you think that. So
the good thing is that, for whatever it's worth, the hype around, or the excitement around their AI accelerator chips, at least we don't necessarily have to call that into too much question. That being said, having interacted with other professionals in that space, they're like,
yeah,
Tesla even claiming, an AI accelerator chip. You don't necessarily need to fight them tooth and nail over that claim either. So
yes,
there is a concern, like with the AI accelerator chip, would that be commoditized sooner rather than later?
yep,
As far as, yeah, so take the good with the bad, make of it what you will.
yeah. I like this comment. You should have seen the Humana one. That one, people flip their shit. That made people
Humana.
flip out. Yeah, Humana. That made people flip out, because I sold for reasons unbeknownst to the reason why it sold off. And people because I did the portfolio update, explained myself, etc. And then the next, what was it? The next couple days, or was it the next day? I think it was the next day. Then Jake the pancake was like, "There's no way." But I didn't make money. I didn't make money in Humana. I just lost less money than I otherwise would have. So how to know when to sell down or a dead money position, aka
Warner Brothers
one of-
Discovery.
well, you're like 110% invested in
I
it,
am.
bro.
I am not. I am not. I have been nibbling along the way. That being said, look,
Let's
it
talk about that.
yeah depends on you and what your view is. Like, if you wanted a tax loss, I can understand, but
I guess it's fair because it's brought up, and I'm not gonna hide these things, but I do not share my options positions. well, as a full disclosure, I have full discretion at sharing my
Mhm.
option positions. The holding co for club members, they can see that, but for publicly discussing on YouTube publicly, I usually refrain from doing so, but I'll do so in this instance. So, club members know that I have, for full disclosure, puts on Warner Brothers Discovery, not buying puts.
Bought.
I
Yeah.
sold puts.
Yeah.
Sold puts on Warner Brothers Discovery. The strike, I'll reveal it for full disclosure, for completeness, is at $7.50. And I have been selling puts and usually not being exercised in Warner Brothers for, I'd say, the good part of this recent quarter. Some of them have been strike of 8, but the ones that I currently have that are still good are at $7.50. So I wanted to get that out of the way before we continue.
Yeah.
That being said, so you're down on Warner Brothers,
Mhm.
and the question is, do you get out? Well, that's very personal.
Mhm.
But why were you invested in the first place? And have they done anything to destroy that idea as to why you originally got it? That's my question to you,
Yeah.
Fisher boy.
I would also add that the sentiment or the statements around Warner Brothers that I consistently see would be the debt. And yes, really awful, horrendous number. That being said, if you care about maturities and the maturity perspective, it's manageable. And whether we want to argue over that or not, from a cash flow perspective, so long as those don't get damaged, I think there is enough support to that claim of at least where it is and where it realistically can be seen. It is manageable. And big scary number has been chipped away bit by bit. So if you wanted more from management, then snap, is he coming in?
Come on, Dan.
Yeah,
You're more than welcome.
yeah.
Argue the case against Warner Brothers, which my argument in favor of Bacon in this case is, one thing that's really good about them paying down the debt is, since a lot of the maturities are so far out, they've actually been affected on the public markets as far as the value of what they have to pay back for that debt. So, as everyone should know, because if you watch Everything Money doesn't understand this concept, but when you value bonds, because Everything Money blundered this horrendously.
Yeah.
When you value bonds, there is a sensitivity factor that is attributed to longer duration bonds in relation to interest rate. This makes sense, right? If I were to loan money to Bacon at a 5% interest rate, and let's say interest rates fell by to 1%, so that's a 4% drop. The change in the value of the debt between me and Bacon will not change all too much, very fractionally, because of the duration of 1 year. But if the duration was 30 years instead, that is going to change by quite a bit. So if the rate fell by all the way to 1%, the value of that debt is going to shoot up, right? If it's 30 years out, because there's arguably, you could argue, if you do the math on how much interest that's going to accumulate, it's quite a bit. And so if I were to now change it to a proposition of 1% per year, you could see by the difference in implied interest payments. So that kind of, if you break it down, that's kind of why the value is so sensitive to time. It makes sense when you think about the total dollar that the debt is going to pay out. So buying back the debt now, they're getting quite a big discount for that. And so that's why management has moved in that direction, because a lot of their debt is of high duration. And so they're getting quite a bit of savings on the debt. But there's a counter argument. The counter argument is the savings greater than the investments they could be making in, I don't know, buying back stock, where you can calculate the value of the stock on internally as an earnings yield. So let's say we're the management team. Bacon and I, we're the CEO and the CFO, and we're looking at this and we're saying, all right, we could buy back the debt. I'm making up numbers. I'm just throwing it out here. We could buy back the debt and get a return on our investment of 15% as an argument. I forget exactly what the debt's trading at as a discount, but I think it is pretty steep. But we are trading at what's Warner Bros. PE ratio at? Is it like 6?
Ugly, that's for sure.
Ugly or pretty? Because depending on your
glass
half empty.
Yeah.
It's forward earnings. Oh no, I forgot it's negative. What's the cash flow yield? Let me just do this quick calc. Give me a second.
Do.
All right.
Be sure you like, comment, and subscribe.
Oh yes, like, comment, subscribe. You like if you're enjoying the live stream. 6 billion. I'm gonna round. So sue me, bro. 6 billion. All right. So 6 billion, and then we do just a little simple 19 divided by. Sorry, 6. Oh, 6 divided by 9. Oh my gosh, no. Cancel all the calculations you have. Jesus Christ. That's an insane cash flow yield. All right, let's round this down a little bit because there, give or take, there's some probably savings from the whatchamacallit, the strikes. Mm-hmm. Let's call it 20%. It came out to 20%. So is your Sauron knows this. I think is watching. Oh no, Sauron definitely knows the answer to this. Sauron, what is the discount on their debt? I forget, but I think it's pretty steep. But the cash flow yield, let's say it's 20% in this example, then we have to make the justification, pay down the debt and get 15% return on our investment, or buy back shares. And if we're using cash flow yield per share, and we're confident as management, we are confident that the business is going to sustain that for the foreseeable future, as far as we can project out. Buy back more stock. Don't buy back the debt. Buy back more stock. So, yeah, that's kind of how I view the answer or the question to Warner Bros. Discovery. It's, as far as capital allocation goes, there's a lot to be there's a lot that could be debated. And it should be debated, but there's a lot that could be debated. Should they be paying down more debt? Should they be buying back stock? In any case, I think that they have plentiful options to deploy that cash in excess of what's necessary to invest in new projects. Good / bad position to be in, because arguably having that much debt is a bad position. So, yeah. I'm going to see Sarah's joint venture for who? Who's the joint venture with?
Oh, which? Hold on, let me double check because I've. Oh yeah. With Disney and Fox and Warner, they're looking at. They announced that like March, I want to say. Certainly Q1 of this year. Should be rolling out fall, I want to say, of this year. So it should be okay.
Fisher Boy's question here, that is like the number one risk to Warner Brothers, is that the legacy business falls off way faster than anticipated. And I view, for full disclosure, I should disclose this, I bought more Netflix. So
yeah,
I
do think, like, from a core business perspective, though, like, why Warner would look awful or would have looked awful from an EPS and net income perspective is their pipeline has been really awful, especially during the writer's strike. But now I think we're witnessing the inflection of better pipeline going through as far as finished goods and better in the works productions. So, we can make of that what we will. I just think for the price of where it is at and the narrative around it, it's worth a small little supporter.
Yeah.
That I can nibble around. And again, I totally understand and respect the counter arguments to my position of core business. Oh, this is a melting ice cube. This is ugly. This is not going to work, and that is horrendous.
Yep. Oh, by the way, Henry, yeah, that's why I reduced it to 20% yield, because I assumed like, yeah, it was really high. So yeah, Warner Brothers has a lot to prove. That's actually why I decided to not go along the comments here, because honestly, it's an idea that I already have exposure to what I view as like the #1 streamer, and I do have exposure also to the #2 streamer.
Oh, you're still. Oh. I thought you were gonna say the House of Mouse.
No. I might regain exposure, because that is another one where we sold, and arguably that was a good signal to sell. We didn't get the exact top, but we sold it because the manner in which Disney conducted themselves through the proxy battle, I thought was not something I could get behind. And so we decided to exit. And since then, the stock has traded down. I was going to talk about this when we got to the portfolio update, but yeah, Disney's no longer in the portfolio. I sold it in both the holding company and my personal holdings. It's gone, but we might end up re-adding at some point if the price gets right, because I still stand by the things I stated prior, that this year they guided up on the amount of cash flow they're going to be able to produce. They are making a lot of changes that I do agree with. And a really dumb reason. Have you guys seen Shogun? A really dumb reason. That's a good, it's a good show. And the debt profile of Disney really, frankly, is not that bad, especially when you count duration on that debt. Like those maturities, it's like ridiculous. I wouldn't. And they did really make some good business decisions during COVID. Oh, there you go, monetization, but whatever.
Oh no, Pandy Wendy.
Pandy Wendy. But yeah, no, I'm just kidding. The YouTube algo doesn't actually catch that single mention. But yeah, it's just get ready to get clapped, Bacon. We're both done. We're done.
We're done.
It's
Rip. We had a good run.
It's Jover.
You guys are insane. What the hell are you doing here?
It's Jover.
Understand?
It's so Jover.
Like, maturity talk is cool when like at least the debt's within a range of like possibilities of paying off or deleveraging. Like, you could buy 3 super carriers and still have more debt. That's how much Warner Brothers has debt-wise. Like,
all right.
This is like an insurmountable. This is like the Mount Everest of debt.
Fight him, Bacon. Fight him. I'm gonna hide behind you.
You guys keep saying that. I don't care. It doesn't matter what the interest rates are. It's beyond that. We're beyond that. It's like a black hole of debt now, right? So if you had a $50,000 a year job, right?
Yeah.
Say you had $300,000 of student debt. Does it matter what the interest rate is? You're screwed, like regardless. So you could be just less screwed, I guess. But
no, but what if the debt is the maturities are so far out in the future, and when you're buying it back early, you're paying down less debt than what you owe?
Well, you're saying then what I've been saying. They need the Carvana guy to come in and like renegotiate debt beyond just pushing out maturity dates, because he slashed debt off of Carvana's books.
Yeah.
And that caused the stock to rip. Like, outside of that, I don't know how you salvage this, but that's beyond like, just saying, oh, push it out further. Like, they literally wiped that off their books when they renegotiated it. So,
because I think like Warner Brothers has a lot of debt. A lot of the debt's due past 2029. And so the discount on like the market discount on that debt's already quite high when you consider that rates are higher now, and so they can buy back the debt at a cheaper level than what they actually owe back, because they paid the market value for the debt.
Also, they're in a business where they need to take on debt to produce and finance movies. So now this debt also affects future rates that they're going to have to take on, right? Like Dune or something. So I would assume they were taking a loan on to finance Dune, and then you get it back when it gets released. So
yeah.
So this is increasing their production costs now going in the future on top of this black hole of debt they have. So,
well, let's let's talk the numbers here. So you have 41 billion in long-term debt. Cash flow, I'll reduce it for the sake of the writer strike to let's kind of look at what they did before, and then I'll just use that as free cash flow. And I'll try to take the smaller amount because now they're a bigger company because they have Discovery. But let me try to be. Let's see if they're actually cooked. So let's take 2022's free cash flow figures, and that comes out to 3.3 billion. So let's say they stay within that range, 3.3 billion. They have 41 billion in debt. 15-year average maturity, according to Emperor Sauron, which he said there, at 4.6%. 3 billion free cash flow. It's a tight ship. You have a point though. That's a tight ship. 41 billion. Let's say they're not going to have room for anything else, or room for very little. And so maybe that's arguably Sauron, by the way. That's probably why the management team who's running the ship is deciding their main focus is debt. Because if they can do as much damage as they can to the debt pile now, it puts them in a much more flexible position. And then arguably, not arguably, literally, when it comes to the debt comes due, let's say nearer term debt comes due, and you have a lower debt profile, it gives you a greater ability to go back into the public markets and then raise more debt. Because if you can get your credit profile up, you can then push back that debt, and then cash flow should actually benefit from that near term. I think they can do 5 billion in free cash flow, 4.5 on the more conservative. Yeah, I went way too conservative. I know that because I took the smaller business. Because I think that wasn't Warner Brothers, that was Discovery. So, yeah, let's take the 4.5 more conservative. That's about 1.5 billion extra cash flow. Doable, right?
Mhm.
So I don't think it's not doomed. So this is.
I mean, you have other problems too. You have the goodwill of this business has been written off pretty sharply since they created this company. So you got like, what's that about? Looks like $10 billion of goodwill has been written off. So I don't know.
I can't replace House of the Dragon, meet Kevin.
And like, you got deteriorating cable business. Disney's a similar debt load, but they have more operating free cash flow coming in now because they've made appropriate cuts, increased cost of Disney Plus. Warner Brothers Discovery doesn't have the same levers to pull than Disney.
They don't have parks. Yeah,
they don't have parks. They don't have cruise ships, which are growing businesses.
Cruise ships are doing really good right now.
Yes. That's what I was telling you. I'm like, if they ever broke out when we owned it, I'm like, if they broke out the cruise ship numbers separate, we would have seen like 15% increase in the stock, I bet, like immediately. That value that they kind of have hidden. But
oh yeah, no, Disney's Disney, I think, was just poorly run, and they are a monster of potential in terms of how much money they can make on any given year. A monster of potential.
But you know, it's funny. So I think I said to you when I bought it at 80, I said it was worth $120, and that's about where it got to. But I bailed on it before then because it started to get me worried. But
yeah.
So I don't know. Someone said, "Is it uninvestable?" Like Warner Brothers. I mean, to me, it is in its current state. But
this image, I think, is where been asked to share. So long dated, low interest rate debt. So this is from their investor presentation, and this is as of December 31st, 2023.
Yep.
So we can see how it's like kind of broken out. And so this is like obviously like the maturity dates. Interest expense, I think, averages out to 4.6 across the loan book.
Yep.
Or the debt book, not loan book, because they're not loaning money. But yeah, so We have 1.8 billion due this year, then a big one due in 2025. So the problem is, if they pay down this stuff early, there's no benefit. There's no benefit to pay 2025s besides security and peace of mind. But they're definitely not doing that. Where they're probably paying down first is the deepest discount is going to be this one over here. This one's a big one. You'll get a pretty good discount here, and you'll get a pretty good, decent, okay discount here.
Not seeing a mouse.
Oh,
Yeah,
that's weird.
you could just.
I'll say numbers then.
Yep.
The best one that they're going to get the best discount is 52, then 42, then 32. Those are the big ones. Those are the big years for them. They have to be careful because 2027 is coming due. And these next years, they're going to be coasting after these next years as far as debt maturities go. So these are the years that if they're paying down these early, they're not going to get much value add. But if they're paying down 52, 42, and 32, they're going to get a lot of value add. It's going to be descending in terms of value add. 32 is going to be the least, but still it should be fairly okay for the discount they're getting. But like this decade's the toughest decade for sure. And that's to Dan's point. It's going to be a tight ship. So you have 2024. If they dedicate $2 billion a year to paying down debt, let me do the math real quick. It's not going to cut it by 2027. $2 billion a year unless they refinance, because that 1.8 is already almost gone. You have 200 million surplus. Let's say you throw that in, then you're still over. So call it $3 billion a year. $3 billion a year in the budget to pay down debt. Zaslav has entered the chat. Oh my gosh. Yeah, $3 billion a year just for debt payments, and
they're paying
finance
$500 million of debt per quarter. This is mind blowing. Like
they're doing $2 billion a year.
Yeah,
that's not enough.
So $7 billion-ish, $8 billion of operating cash flow, $2 billion just interest costs. Like,
not interest. No, not interest. That's just the principal pay down, right?
Oh wait,
it's
I'm
worse.
sorry.
Yeah, no, it's worse. So I said to your point, it's worse because there's the interest expense in addition to the principal pay down. So that's cash they have. So $2 billion a year in principal pay down, plus in addition to the interest expense. And so
I'm on the wrong time. There it is.
Yeah, we have, let's call it $3 billion budget for debt. Yeah, you don't really get there.
Oh my god. Yep.
Oh no, Marcel says the interest is $2 billion. No, they paid $2 billion because for the whole amount, $2 billion in interest.
I think it's $2 billion principal over $2 billion interest.
Yeah, 1.7.
I might be wrong.
No, it matches up. Marcel says 1.7 principal, which is $2 billion more or less, and then $2 billion interest. So before we get into additional pay downs, right? Paying down the debt further down the road, yeah, it's a tight ship. Not impossible, but it's a tight ship. And I guess the market is hedging its bets. I wonder why, when they were like double the price, they didn't issue a bunch of stock. It would have been painful, but really, really necessary. The stock price went down anyways. That's the point. Hindsight's 2020, but the stock price did go down anyways. And so you probably would have been better off had they just issued a bunch of stock. So what's the solution? I need an answer.
I mean, that would have been an option. Just what's their market cap? Like, oh, I don't know.
Oh, Marcel posted it. Let me go ahead and pull it up.
No, they can't do that. I was to say issue $10 billion of stock. No. Yeah.
Yeah, look at this. This is gonna be a tight ship. Interest payments, 24 billion. Interest. The banks love him.
I would just like, I would say like, like credit, like it's like personal debt, right? Like terms of the debt matter until you cross like a certain line, and then it doesn't, and then it's just out of hand and you're done. Like,
so you know who should buy them? Netflix.
SoFi? No.
Netflix should buy Warner Bros. Can you imagine having all that IP? Oh.
You guys should have bought Paramount, because it's been pretty apparent for like the last 6 months to a year that someone was going to try and buy Paramount. The question would have been, what's the likelihood of it going through?
Yeah.
Sony and Apollo.
I mean,
think
it's
they
not that great of a trade. I mean, really, it went from 9 to 12. So, I mean, wouldn't have been worth holding it for a year for 25%. But
Lena
Dan-
Khan is into the chat.
Dan's like 25% in 1 year. No, we don't. We aim for 50. And then Kemmer's like,
I'm not impressed.
50. I aim for 70. Or what does he aim for these days? 86%.
But Paramount, I figure they get bought because their they have great IPs in Paramount that would justify someone looking into it and buying it.
Oh yeah. I mean, it's so funny. Like, what if we see legacy media all just like die and get bought up by larger and larger companies? It's like big tech. Big tech owns media too.
Well, you forget, remember there was the rumor that Paramount was going to merge with Warner Brothers.
Oh yeah, yeah.
What a
Yeah, that was a
nightmare.
fun
Like,
rumor.
you're going to take this pile of garbage and this one, and you're going to merge, and that's going to solve everything. Like, unless they would spin off like a company that took all the debt on, I guess.
Not saying it's going to happen, but in a bankruptcy outcome, on the other side of things, buying the commons after the debt holders take over, Warner Bros. Would be interesting.
Okay, why not? Why not split it? Take Discovery, call something Discovery, throw debt on it, then
Lawsuit.
create it
That's-
Warner. I know. It would
That
be
is a lawsuit in the making. They will sue the absolute living hell out of you.
you bet.
And the courts would definitely not side against you. Yeah.
I mean, put like the 60-day dating shows with Discovery, all the trash, right? Along with the debt.
Yeah. No, yeah, they would get sued like crazy. But obviously that would be an amazing outcome for the remaining shareholders in the RemainCo. Just like spinning off a business, piling on the debt. Oh wait, AT&T did that. Oh wait. Yeah. It's really unfortunate. It is really, really, really unfortunate that AT&T did that to them. Otherwise it would have been like, I think, a more obvious play, which is why I'm playing cautious. I might get called on some of those, or assigned. Is a better word. So I'm watching them like a hawk, but the strike price is $7.50. I mean, the cash flow yield would be pretty good at that point, but it's not going to be that big anyways if I get assigned.
Dividend.
Wait, Henry said there's a Paramount family.
Mhm.
How's that?
Yeah.
There's a family called Paramount.
Yeah, where do you think the name comes from? All these companies. There's a family called Netflix. No, I'm just kidding.
I only know Paramount because of the Huang, the leverage thing.
Oh yeah, Bill Huang. Good old Bill Huang.
You don't know about the Netflix family? Or the Amazon family?
Do you remember? Do you remember when Everything Money did an evaluation of what I think it was CBS back in the time, or Viacom? So he punched it in. He knew nothing about them, and you could see on the chart the spike of when the Huang event, where it got the crazy leverage, when the stock went up like 5x. He didn't know that, so his valuations, all the numbers were green when he hit the analyze button, and like he didn't know what was going on. It was Paul or Mo, I don't remember, but like he's like, oh, what? He like they didn't understand because he's so used to seeing it all say red, don't buy it. But like his system, he didn't. You can't change that in his system to reflect that one event.
Yeah, I think I reacted to that back then, by the way.
Mm-hmm.
Yeah.
There was certainly the what's it called moment? The Peloton moment with good old Mo.
I forgot about the Peloton moment.
Yeah, I remember. Their system had a critical flaw, and you identified it pretty quickly.
What was it? What was the Peloton moment?
So he punched in his standard Everything Money stuff, but if you look at a Peloton company at the time being unprofitable, and you, even with modest assumptions, ranks it up if you don't make any adjustments, like a normal thinking
Oh,
person.
yeah.
You're gonna buy it all day.
You can't really their middle school level DCF, like you really can't use it on profitable companies.
You can't use it on anything. It's not. It's not good.
Technically that too. So,
It's
tech
really not good.
companies, cyclical companies, like you could use it on like Coca-Cola probably, but Procter and Gamble.
Yeah. You could.
It's
Okay.
funny because like they used to say like, oh yeah, don't use this for like banks or like financial service companies, and then like lo and behold, like they'll pump out videos on using their tool on banks and financial service companies. Go figure.
Mo got a buy price of Netflix at 80 cents. Well, I already told you guys I bought more Netflix.
Interesting.
Am I overpaying? Maybe. No, but I didn't buy a crazy amount of Netflix, but I bought more Netflix.
I almost bought Meta when it was 420. I almost did. I should have probably.
I should have bought Meta. All right, so let's see the last bit of stuff that we wanted to talk about. Google back, we already talked about that. Going long even more.
Portfolio question mark?
It is. We're gonna mix it with the portfolio update. So we were kind of hinting at it where, just to be vague about it, but to remind club members, like prior to 2 weeks ago, we were pretty much capped out. Events happened. We're not capped out at all. But on the weekly call this week, I basically put a call out for, that the sell-off that we saw in the week prior was not a reason to panic whatsoever and was a buying moment. And so I decided to go way longer. So that being said, as far as continued firepower, there's still quite a bit of firepower left to go. But yeah, we did make some interesting buys and we sold some stuff. So we'll talk about the portfolio update. So
Dex.
Dex.
He's talking about this upcoming week, Square reports.
Yeah, he's talking about the Square report. I know.
This is where you talk about tech. I should exit the door.
Oh,
no. There's land. There's the company named.
No, you don't have to humor me. That's all right.
The Weston family. The Weston family.
I don't care about potatoes. Like, have at it. But
well, I'm offended.
People keep asking me. My name's not Weston, first of all, people. So
as a viewer, I feel lied and hurt.
I feel lied too. Hurt. Yeah.
What do you mean? You friggin' LinkedIn me, but
that's true. But I still feel lied to. And hurt.
I could change it.
Change your name. Okay. Change your legal name. Yeah, do it.
Wait, Berkshire is buying or is part of the Liberty Media Sirius merger talks, and I was like, was that the secret stock that Berkshire buying last year? Because some people thought it was Sirius Media. Did we ever? I don't know if it was ever disclosed.
I don't know either.
Because there was that stock that Berkshire bought for 2 quarters. They got approval not to disclose it last year, but I don't know. I don't know what it is.
The mystery stock.
Because they didn't want to move it. Yeah, and regulators did right by giving them the permission to not disclose it. All right, so portfolio update. I'll be very quick with it. I'll kind of not bore everyone through it, but I actually blacked out some of the names that are very new because I want to give club members the ability to digest it before publicly. I made that decision. You guys might get mad at that, but I'm sorry. Got to do it. So I'll talk about most of them though. So as far as the update goes, we bought more Amazon, we bought more TSM, more Netflix. I ended up building up a larger position in British American Tobacco. Again, club members, it's not really a new update for you guys, but
are you sharing it? Question mark.
Oh shit! Sorry.
Yeah.
So
my value add.
Tobacco. Let me zoom in for everyone. Yeah. British American Tobacco, Arista Networks got a boost. Vertiv Holdings also got a boost and reported earnings recently. Fantastic earnings and still really good tailwinds. Allison Transmissions got a small boost. Corpay, nothing happened. ACSC, nothing happened. Pretty much nothing happened for the most part there. Arista Networks got a boost. I also added a new position, Lamb Weston, that I can talk about. I also added a new position, Ingalls, that I can talk about, or happy to talk about. Coupang, nothing happened. High Tide, nothing happened. CrowdStrike, nothing happened. I sold a bunch of stocks that I'll discuss. Quanta Services, Walt Disney might re-add, so don't be surprised to see that in the future. I sold Palo Alto, Games Workshop, Uber, Rick.
Oof.
All right. Yeah. Let me talk about why, because then this live stream will go into like the rationale as to why I sold each one. So Quanta Services, I sold them because I felt that the other investments in that theme would do good, or if not better. And so we made good money in Quanta Services. Quanta Services is an engineering firm that focuses on energy infrastructure. And I also sold Walt Disney. Kind of already talked about that as to why we sold Walt Disney. Looks like it was a good move for the time being, but I still view it as a company that with a lot of potential. I stand by everything I said before prior to that. So if you looked at a little bit older updates on Walt Disney, there's a lot of good things in there. Palo Alto, I sold it because frankly, for me, I couldn't justify the valuation of what I was getting, and I wanted to redeploy that capital elsewhere. So we'll see how that really pans out. But if I get a really good valuation on Palo Alto, you'll see me re-enter. Games Workshop, they did something recently that made me think they don't really respect their own IP. And I saw that the move for management was a low payoff, high risk, low payoff move. And I can't get behind management like that, but could still work out. Uber, I sold Uber actually to buy a new position, or I sold Uber not to buy a new position, but I sold it and I got a replacement position for Uber. That's one of the blacked out names. Club members, you guys know which one that one is, but yeah, Uber is. I think the thesis for the most part played out. I don't really like the valuation too much. It wasn't the biggest position. It's not a core position. Like I said, with a core position, you'll see a lot less playing of the soap. Not a core position supporter. So yeah,
I mean, Tesla's going to take them out, so good thing you sold it, right?
kind of funny. Yeah, CrowdStrike.
All of a sudden, they have a ride-sharing app. Who knew?
Oh yeah,
Out of nowhere.
Marcel, I did not add more meta in the personal holdings, but you probably have noticed. Oh wait, no, that's right. So I'll at you in the portfolio update today, because I was going to release the holding co portfolio update, but you'll see that there was more meta, and now I disclose that to the public already. So, but because it's a public stream, but you'll see that I didn't add more in the personal holdings. And then I also want to address Zillow Group, which I already updated as far as sale goes, but just in case, because I can't recall exactly if I did or did not give this update. But Zillow Group, we sold it a while ago after the bigger drop, and I just kind of wanted to take risk off the table. With Zillow Group, there was, of course, the lawsuit that occurred, but really looking at existing home sales really kind of take a beater that could change and could do really well for Zillow. So kind of an upbeat, let's call it, take on Zillow. There's really a good amount of tailwinds that Zillow could experience if we see rates come down, just because existing home sales might boost up, and that will be very good for Zillow's underlying business. And that pretty much covers all of it. So yeah.
Dan, out of curiosity, what was your thoughts on Ingalls market?
We can talk about that. Yeah.
Yeah, because that's one that,
Is it a grocery store?
Yeah, it's
Yes,
a grocery
it is.
store. Yes.
He's like trash.
Like
I don't know anything. I don't know anything about them.
If you want me to butcher your pitch, Fabio?
Go for it.
Where it's priced right now is below price to book, and while the family is very hesitant to do any sort of buybacks, they historically have done buybacks whenever the share price gets around here. They are not shareholder friendly at all. Like, so finding info will be like pulling teeth. Because the family just views it as, oh, we're just here. Core business is simple and straightforward enough. Grocery store chain. They don't like being beyond, what was it, 200 or 250 miles as far as like store expansion of the nearest distribution hub. That's like the maximum they will do. Disciplined, nice regional, smaller grocery chain. But for the price,
very, very cheap, especially when you consider the real estate value.
yes, they own
They're
the real
trading.
estate.
They're trading well below that real estate value.
Oh, I
Honestly,
see what you mean. 0.87, 0.88 price to book. Okay.
Yeah. So that's not a
Yeah.
massive hold forever. Just
Operating cash flow took a nosedive. What the hell?
you have to normalize
Something
it.
happened. Other
pre-COVID.
activities. Okay. Interesting.
After everything's normalized for like the COVID jumps, it's very interesting proposition.
and demonetized. Said it twice.
Oh, yes. So no, all in all, it's
Their long-term debt is only twice their cash. Wow.
Wait. You know why you should be even more impressed
That's
by that?
very impressive.
You should be way more impressed than that. You know why?
They own the real
When
estate.
when you own a lot of real estate, you would expect to have a lot more leverage.
Okay, let me look property. I'll look. I'm curious what kind of property they have.
Their own grocery stores.
10K. How much detail is in the 10K about it? Is it just like how many they own, or
Yeah, how many they own, stuff like
Okay.
that. And you're gonna have to request it, by the way.
Wow.
Or go on Edgar's. No, they have additional supplemental investor information. You have to go on their website and request it.
Like I said, not shareholder friendly at all.
But yeah, they don't have like their investor portal does not have all the information right there for you, the additional stuff. But yeah, you can definitely find their filings. They get back to you pretty quickly. But the additional kind of I'll kind of help you out through the like fast tracking this is the real estate that they do own. It's them being the anchor tenants, and then they own the entire strip mall that they're in. So all the other businesses, they're all their tenants. And that's kind of why they spread slowly is they buy the land, they develop the property themselves, and then they own the property, they rent out the other spaces, and then they are the anchor tenant themselves. They also do sell gas, by the way. It's cheaper. So in their areas, they're usually the cheaper gas station option. So they also have a lot of other vertical integrations in like the dairy business that also when you go to get milk from Ingles, you notice the price is actually significantly cheaper than let's say. And so they have some products that they're like the go-to in the areas that they operate in, and people will go out of their way to go to them rather than someone else. Yeah, it's a good business. It is a good business, run decently well. The Ingles family has like a token dividend in there. They don't run the business anymore. They just are on the board. But the dividend's like frankly a joke. It's just there to support the lifestyle of the family. If you ask me, they don't grow it ever. They grow it sometimes, I guess when they feel like it. And then they mostly just do buybacks, opportune buybacks.
Yeah.
And
namely when it's below price to book.
Yeah. And the chairman of the board, the Ingles inheritor, he hasn't sold any Ingles shares. His sister, though, she sells all the time. But he who owns the majority, he never sells. He does get a nice salary for being on the board. It's about $6 million a year.
Quite healthy.
And quite healthy, plus the dividend.
Yep.
When you consider how much he owns, he is living good. He's definitely chilling. But they run it fairly conservatively all the way through. And so usually every time it gets down to this valuation, they initiate share buybacks and they buy back quite aggressively, and then they stop. So
fun
yeah,
one to just have on the radar.
Yeah, Marcel, if you do a lot of buybacks, especially at valuation below book, it's very accretive.
Yeah.
It's very accretive. And historically, this has never been below book value for too long. Not saying that that's indicative of what's going to happen in the future, but I think the longest I've ever seen it stay below book is like a year, almost a year, like 9 months.
It's not a turnaround play.
No. It is just under
just because the stock's cheap doesn't mean it's turnaround play. Seems like
it's not covered. It's like not covered. No coverage on the stock. So,
well, I mean, like the most ideal drops in stocks are company is doing fine, macro events happen to them, but they can deal with it. That's when you get, that's ideal, if that's what this is kind of.
Yeah. There's always
You know,
questions.
increased costs hit them, right? Which we hope are temporary for higher interest rates and probably their inputs with the farm with food. So, and if they're in the parts of the country I'm suspecting looking at this, they can't really put those costs onto their customers, I bet. In some of these areas I'm seeing they're in the southeast. So,
Correct.
Yeah.
Certain the country, you can't just raise prices to cover yourself. Like, to a point you could, but
yeah. I've invested in them in the past, by the way. So this is me kind of getting back in. I bought them in November of 2020. Funny enough, because I visited in Ingalls when I was at the cabin, and I was like, cabin.
Okay. So see, there was a Fabio one that you may be interested in, even though groceries most of the time, and rightfully so, a lot of people will be like, grocers, ew. But
why are grocers ill? Grocers a good business.
I keep telling you the narrative on it.
Why?
The narrative. Inflation. That means low margin business, awful in inflation.
It's literally, I mean, that makes no sense.
That is the narrative.
That makes no sense. That's people who don't understand what a grocery business is. Yeah, that's someone who does not understand grocery business, and it could be that it's not for them. But yeah, like Kroger as a business is it's a good business. Sprouts Farmers Market is the one that was like the worser run grocer that then made some massive improvements, and then put the switch on to just do share buybacks. And then you kind of see what's followed. They've done really well. Ingalls does not care about doing that. So
they'll just buy back quietly.
Also, if you know an Ingalls near you, you notice like they're actually pretty nice stores. They're cheap, but they're pretty nice. So they're much nicer than a Walmart, and they're decently cheap. So. Okay, I don't know the first thing about grocery. Can you say more about where the appeal is in the business type? So with a grocer, there's a lot of different things you can sell to the consumer, but depending on what the scale that you've achieved, you're generating essentially a spread between the customer and products, and hopefully you're trying to manage that dynamic relationship of moving prices on, but over time. You're a business that I don't view as entirely affected by longer term rates of inflation, except for hyperinflation. Hyperinflation is your enemy, but modest inflation is not your enemy. Modest inflation is perfectly fine for a grocer. Increases the nominal, sales and profits generated by said grocer, and at that time you're basically focusing on improving logistics, and that's your moat. And like achieving providing fresh produce to the customer and doing so in the best manner. So it's how good are your logistics. In the case of Ingalls too, there's some business parts that, like their dairy business, vertically integrated, so you can achieve different value adds there. And in also the case of Ingalls, and they're not the only one who does this, Kroger does the same thing. There's like the real estate component and how you manage that. Very few of them are pure play, like just, we only sell the food. And when you're also like the real estate developer and you're the grocer, which is typically the anchor tenant for those strip malls, there is a component of like, well, we know we want to be here, and so we're the value add to this real estate property, so that then therefore is like a self-virtuous cycle to the whole property as a whole and those other properties next to you that you're renting out. So it's good.
Yeah.
I must have missed it. Why is Ingalls so cheap right now? Undercover. That's all I can tell you. I can't really say it's for a good reason.
What's going on, Dan? I can see facial reactions.
Simpson Manufacturing is just, dare I say, fair value finally, and I'm like, if it dips anymore. But
Simpsons Manufacturing.
yeah,
Yeah, that's one you've had your eye on for a while, I think.
the one I miss forever.
Let me see this one.
Is back, baby, maybe.
All right, we can close out the live stream though, because I gotta go consume food. All right. With that being said, thank you guys so much for watching, and I will see you guys on the next one.
We'll do it live.
Okay.
We'll do it live. It. Do it live. I'll write it and we'll do it live. Thing sucks.